within this region, we are really in for a very wild ride.
There is something different in Japan today that has not been there for the past 30 years.
Hello and welcome to the Investor's Guide to Asia, where we promise to decode and decipher what's going on right now in markets and take a deep dive into the investment stories from across the region. I'm Stuart Rumble, Head of Investment Directing for Asia Pacific at Fidelity International.
And my name is Taosha Wang, Multi-Asset Portfolio Manager. In today's episode, we'll be talking about how Asian economies are faring in the brave new world of high tariffs, and where should investors be paying their attention to.
Brave new world indeed, Taosha. What a ride that we've had in markets since our last episode.
Absolutely.
I mean, I think we all anticipated, obviously, the US and China trade tensions, but I don't think many had anticipated just how far and how quickly they would escalate. We've had significant volatility in markets back to the levels that we last saw during COVID.
Yeah, that was a true shocker. And then the crazy thing is that markets sharply drew down and then sharply bounced back. I think this kind of whipsaw in market is really difficult in general for investors to navigate.
I think one of the things that really kind of struck me this time, though, was the questions that are coming up about US exceptionalism and the sort of trust in that belief, right?
Absolutely. I think we observe a general structural rethink about US exceptionalism, and international investors in general are thinking maybe it's time to put out more home bias.
Lots to get into today.
So let me introduce Fidelity International's Asia Economist, Peiqian.
And multi-asset portfolio manager, George Efstathopoulos, both joining us from Singapore. Welcome, George and Peiqian.
Thank you for having us.
Thanks for having us, Taosha and Stuart.
Welcome. Well, let's start with tariff, which is the key word today. And question to both of you, and a quick question. What do you think is the sustainable level of US tariff on Chinese goods? And one number, please. Starting with Peiqian.
It's hard to pinpoint a number, but what I want to say is that the Pandora box now is open and that we're in for a very wild ride. I think what we can see for sure is that the global trade order will likely to see significant change and companies now need to adapt.
George?
Again, difficult to give one number, but I definitely say that the number that we are today, triple-digit tariff numbers where the two largest economies are slapping such large tariff numbers to each other, that's certainly not sustainable.
Starting with China, we've obviously seen some decent economic data in Q1, but now we've got tariffs to deal with. And it's quite a confusing picture that I see. On the one hand, we're hearing about factory orders being cancelled, sometimes trucks of goods just outside the US border being held up. But then there's resilience among some Chinese companies being able to pass on higher costs. So, Peiqian, where do we actually stand in terms of economic impact on the Chinese economy with regard to tariffs? And where are we today?
I think in terms of the macro backdrop, we are just stepping into the new regime of the tariff world. Stuart, you mentioned earlier about some signals, lots of noises coming from the data, whether it's top down or bottom up. But I think it's important for us to kind of having a status quo update on China where we are prior to the tariff coming into effect. China was at the early phase of recovery. There has been a policy pivot which was somewhat decisive into supporting growth in Q4 2024. Now, with that package of stimulus running, it's safe to say that China's growth is on track for recovery. But with the tariff kicking in, are we going to see a renewed slowdown? Yes, it's possible if tariff stays at these prohibitive levels. But is it possible for China to tide it through with some resilience? I think it's possible too. It largely depends on what kind of stimulus in terms of scale, timing, and pace of those being rolling out to offset some of those headwinds that's about to come.
I want to pick your brain regarding the latest round of monetary stimulus announced by PBOC. The market's reaction seems to be quite muted so far. And I'm wondering if the Chinese market has developed sort of a buy the rumor, sell the fact kind of a muscle memory to any stimulus announcement. What's your take?
I think this time around, the stimulus is slightly different from what we would have seen in the past few episodes of easing. The clouds that's been hovering around is the word called uncertainty. The reason that market reacts somewhat muted is because it's very difficult to assess the likelihood of the actual damage of the tariff that's going to bring about in the coming quarters and months. And on the other hand, we do see stimulus and easing packages being trickling through. But if we dive a little bit deeper into this particular announcements that's being announced by the PBOC and the finance regulators, I think the whole purpose of that is to stabilize market sentiment as a top priority. And that's exactly where the right way to approach in time of uncertainties, in my view.
I would also jump in there and say the Chinese equity market is one of the best performing equity markets this year. Double-digit returns so far. So in some ways, you can also argue that there is a luxury of being a little bit more patient because the bigger picture here is what happens on the trade war negotiation front.
George, can I just stay there on that topic? Because the investors that I've been talking to before the tariff announcement were getting really excited about Chinese equities. So obviously, we had the DeepSeek announcement we actually covered in the last episode that renewed enthusiasm around innovation within the country. And you mentioned, obviously, sparked an equity rally. It's been set back a bit by tariffs. So is now the time to invest, to get in?
This is this third time lucky or so with Chinese equities, because in the past few years we've seen a few episodes where Chinese equity markets have rallied and then sort of they fizzled out, right? The rally has subsided. What I would say is for the past few years, whenever we've seen a big rally, it's been driven by hope there's going to be some sort of stimulus. And then it has been that, buy the rumors, sell the facts sort of situation. I would argue that the rally that started pretty much late Q4 24 has been one that has been driven more by fundamentals and less by hope. And what I mean by fundamentals, just look at earnings revisions when you look at China versus other markets. For the first time, China, mostly the offshore market, is not disappointing when it comes to earnings. We've had 13 quarters. That's 3.5 years or so. 3.5 years of earnings misses in China. Something is changing. We're seeing better earnings. And typically, investors follow earnings, multiples follow earnings, flows follow earnings. And for the time being, the offshore market is delivering earnings, then the offshore market is up anywhere between 10 to 15%, depending which index you look at. The onshore market, on the other hand, is just sort of close to that sort of zero line because we've seen less earnings on that front. But perhaps that might be a more interesting market to be focusing on now because the onshore market is a lot less about the tech space, etc. And it's a lot more about domestic consumption, one that's going to be very much linked to what happens on the stimulus front. We haven't seen stimulus yet or meaningful stimulus yet. If we were to see that, I think that could be a very interesting opportunity, especially at a time when you have the national champion essentially in China supporting the economy, somewhat putting a little bit of a floor. Look at VIX, what's happened to VIX and volatility in other markets, whereas the onshore market might not have delivered great returns, but hasn't had much volatility on the other hand either.
And what are the risks to that view?
The risks to that view is essentially complacency. And we've had a lot of conversations with Peiqian on that front, sort of to what extent China is very slow because the data has been coming out and the data has been okay. And as a result, China waits until it does more fiscal stimulus. But most likely, their data will be deteriorating somewhat going forward because we do have triple-digit tariffs that will at some point impact the manufacturing side. We've already seen PMIs drop below 50. At some point, that's going to have an impact on employment. We've had unemployment for the youth for a long time in China. Now we might have an additional pain point. Unemployment on the manufacturing side of things, especially in areas that are exporting to the US. So if that happens, that probably means, if policymakers are slow to react to that, that could mean weakness on earnings and weakness on sentiment.
Just reflecting a little bit more on this idea of the end of US exceptionalism. Obviously, one consequence of that is that we might start to see a repatriation of capital back into domestic economies, Asian economies, potentially the diversification of that capital looking for alternative safe havens. And Asia stands to benefit from that. And in particular, Japan stands to benefit from that. And similarly to some of the drivers of the Chinese economy, George, we're seeing a domestic revival in Japan as well. Peiqian, maybe you can tell us what's going on there in a little bit more detail in the Japanese economy.
Well, I think Japan is in a very interesting position in a historical perspective. Starting from the cyclical, I think we all know that Japan is on a different policy path with the rest of the world. And that's for a good reason, because Japan's domestic economy starts to embark on a reflationary path after 30 years of lost decades that Mark has been labeling Japan with. And that domestic growth looks sustainable at this moment with the decent wage growth for a second year in a row, and also changing inflationary expectations across the economy. So from a cyclical perspective, I think despite the uncertainties we are seeing right now, Japan might continue on its policy normalization with a stronger nominal growth compared to the rest of the world. And that is a very strong support for the nominal growth and earnings within the economy. From a structural perspective, if we put that under the broader context of tariff wars and the reshaping of global trade order, we look at China and Japan, they do have a lot more export similarities over the years. And in absence of China being able to continue with manufacturing expansion across the globe, who can fill in the void of the loss of manufacturing share? Japan, Korea stands out to benefit from a potential loss of manufacturing share if that war goes into a deeper territory. So I think we have seen early signs of increasing capex from a structural perspective in Japan, and that was part of the theme of friendshoring, reshoring, especially in the semiconductor sectors. And I think if tariff tensions broaden or get more intense, Japan could set to benefit from such a big trend.
Very interesting you mentioned that, a lot of the inflationary tension in Japan is coming from domestic factors. But there's this also big deflationary force that's forming around, China not being able to potentially sell as much good into the US, and therefore that huge capacity is going to find a different home somewhere. And for a lot of countries, essentially a lot of places ex-US, that is a huge potential deflationary force. How do you think about these, two tensions playing against each other?
Well, I think when it comes to the inflationary trajectory, yes, China and Japan are kind of on a different regime. If you look at China, the manufacturing overcapacity is a big concern, and that China exporting deflation is a big theme and a lasting theme that's likely to be here to stay. But in terms of that affecting Japan's economy, I think less likely so, just based on Japan-China's trade mix. I think Japan does not really import lots of final products from China to the extent where the inflation in Japan is still driven largely by food inflation, as well as domestic-driven consumer goods and services sector inflation. So that's a more broad-based inflationary trajectory. But back to the question on China deflation, I think that long-term theme is hinged on the fact that China's manufacturing capacity is fairly large and built up over the years. Now, the tariff war is going to complicate things because China is at the supply side of the story. So if there is a large demand shock that's being stopped by tariff, it's safe to assume that China needs to find final demand that's alternative to cushioning such a shock that's to China. That's why, as George has mentioned earlier, we do still have the hope for China's stimulus. And I think that is an effective leverage that China could potentially use or reserved for a larger shock that's coming through the way.
George, obviously Japanese equities have had a decent run over the last 12 months or slightly more based on some of this improvement in the domestic economy and also driven by corporate reform as well. You still like them, but you have a slightly non-consensus view or different view from consensus. Tell us a little bit more about that.
Like Japan, equities, and there's a couple of things. First of all, in Liberation Day, the week after Liberation Day, or the week during Liberation Day, we saw a lot of markets sell off quite meaningfully. Japan probably sold more than any other market, and actually Japan its valuations ended up being at recessionary levels. So if you look at multiples when we've had recessions for the past 20, 25 years, Japan got down there. Whereas if you looked at most other markets, the US, Europe, etc., they were still trading at relatively sort of expensive levels. And in some ways, you could argue, okay, that makes sense. Japan is a very cyclically exposed economy, exports a lot. And in a world where there's a trade war is evolving, is becoming a very big theme, you would argue that Japan could be under pressure. But as Peiqian said, there is something different in Japan today that has not been there for the past 30 years. Japan is seeing wage inflation that is at levels above kind of the levels the Bank of Japan is targeting, and that's changing the consumption behaviors in Japan. That's potentially a very long-lasting theme and can perhaps change the composition of the economy. And as a result, it can change the way the Japan equity market performs. So that's one thing. Let's not just look at the past. Let's also look at how things are evolving in Japan. Another area that I do like that also links to that, the wage growth, the services PPI coming in stronger, is Japan mid-caps. One of the themes that I'm really embracing, whether that's Japan or whether that's also China or other parts of the world, is that of domestic revenue generation. In a world of trade war, I'd like to be embracing more companies that generate most of the revenues from a domestic base. And we're best when that domestic base is seeing a transformation that it hasn't happened in the past 30 years, given this strong wage inflation that's reshaping consumption. So I think that's a quite interesting development in Japan. Mid-caps have actually been performing quite decently and have had sort of better drawdown when it comes to what happened in April. A lot less sensitivity to yen kind of throughout history, because again, it's all about sort of domestic revenue composition. And we're also seeing reforms, those corporate reforms that we love around for the large caps. We're also seeing those for the mid caps, not to the same extent as strong as they've been for the large caps, but again, we're seeing evidence of that for the mid caps. And last but not least, when it comes to Japan equities, with Liberation Day and the big correction, Japan banks got really hammered. Probably one of the sectors globally that saw the biggest, steepest correction. But again, if you look at Japan banks, more than 50% of the revenue base is domestically focused, domestically driven, when Japan, again, is actually doing okay as an economy. And when do you usually want to play Japan banks? When you've got decent NIMs, like net interest margin, that's driven by yield curve. Japan has one of the steepest yield curves versus any other place in the world. And versus its own history, it's got one of the steepest yield curves it's ever had. That's when you want to be playing banks, and at a time when potentially loan volumes will be on the rise. And if the domestic economy is doing okay, again, that's something that's looking good for Japanese banks.
So some significant tailwinds to the banking sector in Japan. And our colleague Patrick Graham sat down with tactical asset allocation analyst Kitty Yang to find out more before the Bank of Japan announcement.
Kitty, thanks very much for joining us today.
Thank you. It's good to be here.
So your job is looking for thematic opportunities for those sort of investment moments that might last for months or maybe a year. And we're here today to talk about Japanese banks. What's the structural shift that's provoked you to be interested in them over the past year?
So it all started when the Bank of Japan announced that they were revising their yield curve control policies at the end of 2022. And they started by lifting the cap on 10-year JGBs from 0.25 to 0.5%. I know it sounds really insignificant, but what it marked was for us the start of policy normalization and a signal that they were maybe nearing ready to exit the negative interest rate policy that we've been in for the last few years. All of this is very positive for banks, because we have been in a deflationary, low growth, negative rate environment for so long. And it was exciting that we're finally stepping into an environment where we can potentially see positive inflation, positive growth, and most importantly, rising yields, all of which will be really good for Japanese equities as a whole, but particularly good for banks.
And so you've done the maths on that. Is that what you're saying? So how does that work out? I mean, obviously, as you say, it's a very small move in actual yield terms, but for the banks, it winds up being a really substantial opportunity and an improvement in their bottom line.
So it started with that move, and since then they've lifted the cap to 1% and abolished it. And how that translates into banks' earnings is that YCC, yield curve control, it targets the long end of the yield curve, whereas when we talk about NIRP, the negative interest rate policy, we're talking about the prime rate, prime lending rate, which is the short end of the yield curve. So the long end, the YCC, how it impacts banks' earnings is that, one, it lifts the yield on the fixed term loans that the banks hold on their books. So these are the loans of SMEs or apartment loans for households. So that goes up. And secondly, it prompted banks to purchase more JGBs at these higher yields. And plus the ones that they already hold on their book, it improved their interest income.
Which all sounds great, but are there risks here that we should be paying attention to?
We're closely watching the factors that we think the BOJ would be watching for assessing the further step in their normalization path. So we're watching the Japan domestic economy and how that's doing, and also what the BOJ calls the virtuous cycle of prices and wages. So, whether inflation is steady above 2%, whether we're seeing the price increase being passed on to consumers, and whether the consumers are using their higher wages, in terms to fuel more spending. So all of that virtuous cycle. So we're watching price data, inflation data, wages data. For example, the Shomto spring wage negotiation. Yeah, all of that goes into BOJ's decision-making factor. We're also watching the external economy for any signs of stress and anything that would cause the BOJ to pause. So they have been notoriously cautious in the face of external volatility and tends to pause and assess when tensions are high. So for example, during the trade talks now. So we're watching any developments in US-Japan trade talks, because obviously they'll have impacts on Japan's growth outlook.
But the risks are very much skewed to the upside for you from here.
Yes, that's how we see it at the moment. So going forward, we still expect the Bank of Japan to raise rates towards 1% terminal rate. Obviously, there's the risk that they could pause for longer and hold rates at the current 0.5%. But as we see it, that's very much already reflected in market pricing. So from here out, the risks are still to the upside. Obviously, should credit concerns emerge, that will be another story. But so far, there's been no concerns on the credit quality for the banks.
Kitty, thanks very much.
Thank you for having me.
And that was Kitty talking with Patrick about Japanese banks. George, Kitty mentioned the moves by BOJ. What's your latest take on the yen at this moment? Certainly, we have seen some significant squeeze of Asian currency recently.
Yes, we have been seeing that significant squeeze. Is that driven by trade war negotiations where sort of as part of the negotiations, we end up seeing higher currencies from here? Who knows? If that's the case, clearly Japan does have a big current account surplus and trade surplus. So you could potentially some of that. But I probably put that on the side and just think, for the past few years, central banks around the world have been hiking. Bank of Japan has been doing nothing. More recently, Bank of Japan has been hiking at a time when other central banks have been easing. For instance, ECB is one of the more recent central banks that have eased, and we've had the PBOC doing the same thing. So Bank of Japan is hiking. Perhaps we might see a bit of a pause given what's going on with trade war, but directionally, given where inflation is and given where good inflation is, because we have good inflation and we've got bad inflation. For a long time, Japan had bad inflation, weak yen, and as a result, importing a lot of commodity inflation. Instead now, yen's up, commodity inflation's down, and instead we have good inflation, wage inflation. So I think that's an interesting dynamic, which probably could mean that the yen could be a decent winner going forward. And not only for its own fundamentals, it's also been proven a really good risk-off asset. So I like it both for its defensive characteristics, but also for the fundamentals.
George, you've referred to earnings revisions several times during this podcast, and that's the changes that analysts are making to their forecasts for corporate profits. And I came into the podcast just looking at the latest numbers, changes over the last 3 months, and I see Japan is at the top of the list, but closely followed by Singapore, which was a bit of a surprise to me. I know the market there's relatively concentrated by sector, but it's an open economy. I didn't expect it to be faring so well. So, are there other opportunities across the Asia region that you see in this difficult macro environment?
Singapore has been doing, as you said, it's the one of the few countries I can think of that's actually got better earnings revisions than Japan has. But Singapore is a very banks-heavy economy that dominates the index. Banks and a bit of REITs, and both of these have been doing quite well. The banks have been doing phenomenally well for the past few years. And again, we live in a world where cash rates around the globe are going to be higher for longer. Again, that's great news for banks. So I quite like the financial sort of banks theme, whether that is in Singapore, whether that is in Japan or other places around the world. But in terms of other themes that I personally sort of find interesting is, again, themes that embrace that domestic revenue generation. And for different countries, that could mean different things. In Japan, it would be about mid-caps. In China, it would be about onshore versus offshore. But there's other places where large caps are big beneficiaries of that domestic driven revenues. And that would be places like India and Indonesia, for instance. India has already been on an improving trajectory after having a bit of a hiccup towards sort of the end of last year. Indonesia, on the other hand, is probably one of those sort of markets where valuations are very, very cheap, and we are seeing some reforms. But both of these markets have very large domestic economies and less sensitive to what happens on the trade front.
And Peiqian, we talked about some of the regional Asian economies have their exports geared towards more specific sectors, and they may be subject to specific sets of tariffs. What are your thoughts there?
I think when it comes to the rest of Asia, there are really three big themes that drives the region. The first one you mentioned, of course, is the importance of sectoral tariff. We talk a lot about headline tariffs at the beginning, but sectoral tariff is really affecting more in this region because the supply chain has been configured in this region in a way that each country are really geared towards its own competitive advantage. So when we talk about, for example, auto tariffs, countries like Thailand, Korea, and Japan will be more affected by such an outcome. But when it comes to semiconductor tariffs, countries and regions like Taiwan or Malaysia are more vulnerable to the tariff. And when it comes to pharmaceutical, we're thinking about Singapore being more exposed to such tariffs. So the design and the outcome of sectoral tariff will have an asymmetrical implications on different economies within the region. The second thing we consider is, of course, the tariff differentials between how US tariff China versus how US tariffs this region. Because since Trade War I, China Plus One has been a big theme driving the trade growth in this region. The exports of this region going into the US has been increasing over the past 7 or 8 years. But at the same time, China's linkage to this region also deepened significantly. Coming to today, I think the tariff differential will matter a lot in the considerations of each corporates on adapting into the new tariff regime. Whether they choose to continue pushing forward China Plus One or they will reshore, friendshore, largely depends on how the equilibrium of the tariff differential settles. And lastly, I think the elephant in the room is definitely global demand. We talk a lot about the tariff, but the impact of tariff is definitely recessionary, especially towards US demand. So in face of if US goes into much slower growth regime or recessionary trajectory, it's going to affect the exports-oriented economies within the region. So I have to say that within this region, we are really in for a very wild ride because there are huge opportunities and huge risks coming at the same time.
A lot of risk and a lot of uncertainties all centered around the word tariff. So at this point, I want to sum up today's conversation with our two brilliant guests today. I thought the overarching theme is obviously this exogenous shock, especially to Asian export economies. But at the same time, if we look a little bit more closely, we see that different economies actually on their different part of the economic cycle. China is certainly at a more earlier recovery stage, whereas Japan is in a much more expansionary stage of its growth cycle. And that interplay between exogenous factors and endogenous factors will really give us a very different set of investment opportunities.
I think we can call it potentially a shift in the world order, and those types of shifts are never very comfortable. It's still a very fluid situation, and that means that markets are clearly going to remain volatile as we see developments unfold. For me, with questions around US exceptionalism, this geopolitical tension, trade uncertainty. I think for investors, it just means that they just need to be a little bit more nimble and responsive in terms of their asset allocation, because this is going to play out and affect equities and bond markets alike.
Absolutely.
But clearly, we've got some opportunities. We talked about Chinese and Japanese equities with some domestic tailwinds, policy support. There's some selective upside there for active investors.
Absolutely.
That's all we have time for this month. So thank you very much to Peiqian Liu, George Efstathopoulos, and Kitty Yang. And of course, thank you for listening. If you would like to find out more about the topics that we've discussed, then please visit the Fidelity website.
And if you enjoyed the episode today, please make sure you share and subscribe wherever you get your podcast from. The producers today are Holly Eastman, Dan Tham, with support from Judy Chen, Tommy Su, Keith Trump. The managing editor is Sub Morton Clark.
For now, from me and Taosha, thank you for watching and goodbye.